Welcome to VTS Options. So today I'm going to go over the short put option. Now this is a very basic trade, it's just a single leg option, but if used correctly it can be a very powerful tool in the option trader's toolbox. For me personally, I trade short puts quite often. It's actually one of my favorite trades. I think it's got a great risk-reward profile, and the Greeks line up well for my investing philosophy as well. So subscribe to the channel if you haven't already, hit that like button for me, and let's get into the short put. Now, like I said, this is a trade that I put on quite often, so I'll go over the basics in this video, but if you are a member of the VTS community, you'll see several more advanced versions of this trade as it is quite versatile. We've got the price of the underlying down here, and then the gain and loss on the left. Now, I always like to learn through examples, so we've got a hypothetical trade here. With stock XYZ currently trading at $60, we're going to sell a $60 put option for $5. To open that in your trading software, you just sell to open a single put option. And this is what the risk profile looks like at expiration. We've got the maximum gain up here, which in the case of short puts, it is capped at the premium we collected. So we sold the trade for $5, and one option contract represents 100 shares of the underlying, so $5 times 100, the maximum gain is $500. For the maximum loss, it is best to consider it unlimited. Now technically the underlying can only drop to $0, but practically speaking, that's a long way from the opening price. So consider these unlimited loss trades. That's why position sizing is going to be so important, which I'll get into in a second with an example. But the important thing to note here is, the break-even point at expiration is the strike price selected minus the premium collected. We sold the $60 strike for a premium of $5, so the break-even point at expiration is $55. That's well below the current price of $60. That's what makes these higher probability trades. We just need the price to stay above $55 and profit can be made. And as I'll get into with an example as well, even if it drops below that, there are things we can do in the future to manage the risk and still come out with a profit. The option Greeks are statistical values that provide us a way to measure the sensitivity of an option's value with respect to other factors. So we'll start with the delta. Delta is an option sensitivity to price. Short puts are delta positive, meaning they profit from increases in the price of the underlying. Since it's a bullish trade and we do want the price to go up, that means it's delta positive. Theta is an option sensitivity to time. Short puts are theta positive, meaning they do gain value with the passage of time. And lastly, vega is an option sensitivity to volatility. Short puts are vega negative. They gain value with decreases in volatility and lose value with increases in volatility. This is why when you're selling short puts, it's most advantageous to be doing it in a higher volatility environment. Vega negative trades like short puts do benefit from a drop in volatility, so having a little room for it to fall is important. And fortunately for us, that tends to be the case when we most want to open these types of trades, as I will now demonstrate in an example. So this is the Thinkorswim platform from TD Ameritrade, and we're looking at the S&P 500. 2019 is officially in the books, and aside from a little down day, we're basically at all-time highs. So first of all, let me take this opportunity to say Happy New Year to all of you, and I hope 2020 is a very prosperous year for all of you traders out there. So remember the short put option. We typically like to open these trades on beaten down stocks, but of course with markets at all-time highs, that is sometimes difficult to find. But in the interest of diversification, I do think it is important to look for them because you do want a nice mix of bullish and bearish trades. So for this short put example, I'm just going to default to a stock that I trade quite often. It's on my watch list of roughly 30 or 40 stocks, and that is American Eagle Outfitters, so AEO. And you can see this chart looks nothing like the S&P 500. Of course, AEO here is actually touching the 6-month lows. So for me, this is a decent time to sell a short put option to play a possible reversal in this stock. So I'm going to go over to the Analyze tab here, and these are all the monthly expirations that we have to choose from. Now, I think this type of trade works best on a monthly schedule, but today we've got this January for 17 days to expiration, and then the February at 52 days to expiration. So I'm going to go a little shorter this time around and choose this 17 January 2020. Now in Thinkorswim, the calls are over here on the left, and the puts are over on the right. We're going to be selling a short put, so we're going to focus on the right side of this screen. Now, most of the time I do try to get as close to the money as possible, selling just outside the money to maximize the premium I bring in. The only time I wouldn't do that is if there was an earnings report or something on the horizon. But earnings has already happened, so during this contract, there's really no reason not to go close to the money. So we'll just use this 1450 strike as the example. I'm going to sell to open a single short put option, and I'll just adjust it for the mid price around 50 cents. Now the familiar risk profile of the short put, they all look like this. This turquoise line is the risk profile at expiration. We've got today's price right around that hash mark, right there, and then the break-even point at expiration down there at 14. The break-even point, remember, is always going to be below the current price. Very easy to calculate. You just take the strike price of $14.50 and subtract the premium that we bring in as a credit of 50 cents. That brings the break-even to 14. Now the maximum gain for the trade is up here. You can see that it is capped at the premium we bring in. It's just the 50-cent credit multiplied by the options factor of 100 because remember, each single contract represents 100 shares of the underlying. So the max gain for this trade is $50 per contract. Now that may not seem like much. Sometimes people think, oh, 50 cents, that's only a tiny credit. But if you calculate that, it's actually almost 3.5% of the strike. So if you view it in the context of a 17-day trade, a 3.5% dividend over 17 days is pretty solid. If you open these types of trades consistently, and especially over multiple different underlines, you can imagine that the rate of return can be pretty significant in the long run. But as an individual standalone trade, it's certainly getting paid enough to open it. Now, it's always important to remember that these trades, while they're not technically unlimited loss because it can only go to zero, in a practical sense, there's a long way down to the left here, so you should consider them unlimited loss trades. And because of that, one of the levels of risk management that I always recommend people do is to trade these short puts in what's called cash secured, which essentially means you're reserving the full capital required to actually take assignment of the shares if it expires below the strike price. So while the margin for this trade may not be all that high to open, I would still always reserve the full $1,450 in the event of taking assignment of 100 shares. That's how much it would cost to hold the 100 shares at $14.50. So trading these cash secured is definitely a good idea, and it makes the trade much safer. I'll get into a second method of potential risk management in a minute here, but let's review the Greeks really quickly. So the first one is delta. You can see here right at the money, we have a positive delta, 42.97. Delta positive trades mean we want the underlying to go up. And you can see that in the picture. Anything at the current price or up is of course going to be good for this trade. So it is a delta positive trade. It's a bullish position. The second Greek is theta. This is also very important for this type of trade. You can see that's a positive number as well, $1.72. That may not seem like much, but that is positive theta, and it is a daily decay. So every day that goes by, we will be collecting a little bit of money. And that does increase exponentially as we approach expiration. So it starts out fairly small, and then it does build over time. So being theta positive is beneficial for this type of trade. You can see that if the price just hangs out in this range, every day we'll collect a little bit more of that theta, and it will go eventually to that maximum profit. And the last Greek is vega. Now, selling short puts is vega negative, which means the trade benefits from a decrease in volatility. That's why it's always beneficial to look for stocks that are beaten down in price for these, because that's typically when volatility will be the highest. Anytime you're selling options, it is more advantageous to sell it from a higher volatility starting point, so it has a little bit of room to fall, and for the trade to benefit from that that negative vega factor. But lastly, let me just show you that second piece of risk management that I mentioned. This is a more advanced type of trade, so I'll definitely do a full follow-up video on this type of strategy. But at expiration, there's two possibilities here. Either the stock will expire above $14.50, in which case we would just keep the premium, that 50 cents would be ours, and the option would expire worthless. Nothing would happen and we'd just go into the market and look for a different trade. If, however, on expiration, AEO expires below $14.50, at that point we would either close the trade right before expiration or possibly take assignment of the underlying shares. This is why it's always important to reserve the full capital required to do that, because you could initiate a second stage of this trade, which would essentially mean that we hold the shares at $14.50, and then we could turn around and sell covered calls on that position for the next monthly expiry. That would bring in even more premium. So while the initial trade might bring in 50 cents, by taking assignment, we could actually use those shares to generate even more premium and actually build a higher rate of return in the long run. So like I said, that's sort of a secondary consideration, but this is one of the reasons why I like this trade so much. I personally call this strategy my wheel of fun strategy. Selling short puts on beaten down stocks. If it expires worthless, you just take your premium and run. If you do get assigned the shares, you've reserved the full capital to do that, and then you just sell covered calls and generate more premium. So you can see how it's kind of a wheel that goes around and round. Short puts to covered calls to eventually losing the trade, finding a new one, and initiating a new wheel. But that is a more advanced trade, so definitely look forward to a full video explaining the Wheel of Fun strategy. Today's explanation was just how to sell a short put option on a stock that's beaten down in price to try to get bullish on this stock. So let me review those points because this is one of my favorite trades and I'm in these quite often. The short put is a bullish trade because ideally we do want the underlying stock, ETF, or index that we're trading to go up. That means it's delta positive. Now it's also theta positive, and like I showed in that example, even if the stock price doesn't move, just hangs out in that middle range, it can still make a full profit because of that positive theta. And as a longer term strategy, even if the stock price does go down below where we want it to, we do always have that backup plan ready to utilize. Short puts are vega negative, so selling them when volatility is elevated is definitely the best starting point. And typically when stocks are beaten down in value and we are looking to get into some of these short puts, that's exactly when volatility is elevated. So the vega lines up really well for this trade. These are limited gain trades, with that maximum gain capped at the premium that we bring in. Now, while they are technically limited loss, like I said, practically speaking, there is a lot of room to the downside, so we want to consider these unlimited loss trades. And lastly, when you are selling options, if it's not on a cash-settled index, if you're just trading stocks and ETFs, there is always that assignment risk, especially on in-the-money trades. So it's always best to just check your trades once or twice a day just to make sure everything's right. Overall, short puts do carry some risk, but I really do like the risk-reward profile. And like I said, the Greeks line up very well for my investing philosophy as well. So I take these trades quite often. So thanks so much for joining me here at VTS. I'm here to teach you the fundamentals of these trades and then scour the market for the best setups. And these short put options definitely put in some good work on that front. See you next time. So if you're interested in options trading, go claim your free 2-week trial on my website. In that time frame, you'll definitely see a wide variety of trade types: iron condors, strangles, calendars, earnings plays, pairs trading. I have many profitable strategies that you'll be interested in. Come join the VTS community.